Silicon Valley didn't die after the dot-com crash, it evolved. In just 2 years, the Nasdaq lost 78% of its value, erasing $5 trillion. 150,000 jobs vanished from the Bay Area alone. Companies that raised millions collapsed in months. And yet, from that wreckage, a handful of survivors quietly rebuilt something far more powerful and far more dangerous than anything the internet gold rush had ever imagined. Money poured into Silicon Valley with a fever that bordered on mania. By 1999, venture capitalists had unleashed $35.6 billion in a single year, chasing the promise of internet riches. The logic was simple and brutal: growth at any cost. Startups that had never turned a profit were handed blank checks, their value measured in users, not dollars. Every pitch deck promised exponential growth. Every new website was a lottery ticket. Bankers and investors, hungry for a piece of the next big thing, lined up to buy shares in companies with no revenue and no clear plan to make any. The only metric that mattered was how fast you could burn through cash to capture eyeballs. User growth charts replaced balance sheets. Initial public offerings became public spectacles, launching companies into billion-dollar valuations overnight. The fear of missing out infected everyone, from Wall Street to college dorm rooms. The more irrational the price, the more desperate the demand. Stories spread of founders in hoodies cashing out before their products even shipped. Behind the scenes, anonymous bankers and venture capital partners fanned the flames, pushing for faster launches, bigger raises, more hype. The system rewarded boldness and punished caution. In this world, even the most fragile business models could become overnight sensations. It was a gold rush built on hope and bravado, with fortunes made and lost on nothing more than a clever domain name and a viral marketing stunt. The higher the stakes, the faster the climb. And underneath it all, a sense that the entire market was floating on air, waiting for gravity to return. The sock puppet grinned from 1,000 billboards, but behind its stitched smile, the math was fatal. Pets.com burned through $82.5 million in less than a year, vanishing in just 268 days. Their Super Bowl ad cost $2.5 million for 30 seconds. The mascot became famous, but every bag of dog food shipped cost more to deliver than it earned. Free shipping on 30-pound sacks meant a loss with every order. By the end, Pets.com had spent $30.7 million on marketing in a single quarter, while sales barely scraped $5.2 million. The public saw a puppet, and inside boardrooms, executives watched the red ink bleed across spreadsheets. A former CFO summed up the disaster. "We spent $30 million on a mascot and never figured out how to ship a bag of kibble." Webvan promised to reinvent the grocery business with a $1.2 billion investment in automated warehouses and a national delivery network. But the warehouses stood half empty. Customer acquisition cost more than the lifetime value of every shopper. In June 2001, Webvan filed for bankruptcy. Hundreds of trucks sat idle, silent in the loading bays. The collapse was not just corporate. It hit neighborhoods and families. 150,000 jobs evaporated across the Bay Area. Cubicles emptied. Office parks turned to ghost towns. Workers carried their belongings in cardboard boxes to parking lots filled with unsold company cars. The gold rush had ended. Hope was replaced by fear. The region's confidence cracked. The survivors would need a new playbook, but for now, the only sound was the echo of promises that could never be kept. Cash stopped flowing. The rules changed overnight. Venture capital, once a raging river, shrank to a cautious stream, just $20 billion a year, half of what it was at the peak. Startups that survived the culling learned to count every dollar. Growth at any cost was dead. Now the only numbers that mattered were cost per shipment, margin per transaction, and the odds of seeing another round of funding. Amazon, battered but breathing, became obsessed with the math of survival. Jeff Bezos drilled his teams on unit economics. The cost to ship a single box, the time to turn inventory into cash. The old playbook was burned. In its place, a new doctrine: efficiency, discipline, scale. Amazon's internal operations playbook, one secret, became gospel for a new generation of founders. The Valley's talent scattered, but the cleverest regrouped. The PayPal alumni, engineers and operators hardened by chaos, fanned out across the Bay. They carried with them not just war stories, but a private network of trust and capital. Facebook, LinkedIn, Tesla, and SpaceX all traced their roots to these survivors. In coffee shops and rented offices, deals were struck quietly. The handshake meant more than the pitch deck. Power moved underground, away from the spotlight. Venture capitalists rewrote their terms, no more blank checks. Every new investment demanded a path to profit, a grip on recurring revenue, and a promise not to burn cash for the sake of headlines. Acquisition became the new exit. Startups merged, folded, or were quietly absorbed by giants hungry for talent and code. The gold rush had ended, but in the shadows, a new empire was forming, one built on discipline, data, and invisible alliances. In the ruins of the crash, a new kind of engine began to hum beneath the surface. October 2000. Google launches AdWords, a keyword auction that doesn't just sell ads but sells the attention, intent, and private searches of millions. Advertisers no longer pay for space. They bid for the chance to reach a single user at the exact moment of curiosity. The auction runs silently 24 hours a day. Every click is measured, every word becomes a commodity. Revenue flows in, not from products but from the invisible footprints each user leaves behind. The rules of the game have changed. Data is no longer a byproduct, it's the asset. Engineers at Google refine algorithms that predict, sort, and price human behavior. The more you search, the more valuable you become. Shoshana Zuboff gives it a name: surveillance capitalism. The business isn't just about selling ads, it's about harvesting the raw material of everyday life, turning private moments into profit. But this new power needs infrastructure. Data centers rise across the country, swallowing entire city blocks. Local governments offer subsidies desperate for jobs and tax revenue. Racks of servers burn through megawatts, storing the traces of billions of clicks. The ad auction demands scale, and the valley builds its moat in concrete and fiber optics. The old dream of selling products fades. The real money is in knowing what you want before you do. After the crash, the money returned, but it moved in silence. In 2008, the Federal Reserve threw open the floodgates. Quantitative easing began with $600 billion in asset purchases. The Fed's balance sheet swelled past $1.7 trillion by spring. Interest rates fell to 0%. Borrowing cost almost nothing. Capital, once scarce, now flooded every corner of Silicon Valley. There was no parade, no public celebration, just the hum of servers and the quiet signing of term sheets. Venture capitalists, flush with cheap cash, wrote checks that dwarfed the dot-com era. Mega rounds, $100 million or more, became routine. By 2015, more than 45 of these deals closed each year, pouring $30 billion into private tech. Startups that might have died in the desert of discipline now drank deep from a river of easy money. The cost of failure faded, valuation soared. Data, not profit, was the new collateral. Behind the scenes, central bankers set the tempo. Every cut to the federal funds rate sent a signal. Every round of asset purchases fueled a new surge. The valley rebuilt itself on an invisible tide, its power growing with every dollar conjured from thin air. Neon logos flickered across America's biggest stage. In 2022, crypto companies flooded the Super Bowl with ads. Millions were spent for 30 seconds of attention. FTX, Coinbase, Crypto.com. Each one promised a revolution, each one chased the same fever that once crowned Pets.com. Billions in digital coins traded hands as valuations soared to impossible heights. By autumn, the market crashed, fortunes evaporated. The cycle repeated, only the names had changed. 4 years later, the spectacle returned. Now it was artificial intelligence. In 2026, AI startups claimed 15% of Super Bowl ad slots, a share even the dot-com darlings never reached. Slogans promised minds that could reason, apps that could predict the future, software that would change everything. Venture capital surged in, chasing the next unicorn. Valuations spiked. The language was new, but the hunger felt familiar. The pattern is hard to ignore. Hype, easy money, public spectacle, collapse. Each cycle feeds on the same emotions: greed, hope, fear of missing out. The faces on the billboards change, but the engine beneath stays the same. Silicon Valley's past is never far behind. It waits, hidden in the glow of the next big thing. Today, the same forces of cheap capital, frantic hype, and hidden control fuel new empires and new bubbles. Greed mutates, never vanishes. The line between innovation and illusion blurs again. Silicon Valley's reinvention is no secret now, it's the blueprint. The next crash is never a question, only a matter of when.